Many.
For more than a quarter century, America's most popular program about the economy, people, and their money, Wall Street Week with Louis Rukeyser, is made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you. By Prudential Securities, with more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. By A.G. Edwards, serving the investment needs of individuals and businesses for more than 100 years, built on a foundation of trust, research, and commitment to investor success. And by Oppenheimer Funds, because solid investment performance and sound financial planning go hand in hand.
Produced Friday, January 12. Tonight's special guests are Pete DuPont, Policy Chairman, National Center for Policy Analysis; Alan H. Meltzer, Professor of Economics, Carnegie Mellon University; and Joseph Stiglitz, Chairman, Council of Economic Advisors.
Good evening. I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when the theme song for much of the nation was "Baby, It's Cold Outside," and the economy and the financial markets duly entered the big chill. How cold was it? Well, nobody could be sure because the ongoing government standoff has delayed release of a number of official reports. But the news that did emerge from various sectors of the corporate world was sufficiently troubling to hammer stocks into their worst weekly point loss in more than a year and a half, as investors fretted that the slowing economy might lead to earnings disappointments throughout 1996. And it was notably hard this week to come in from the cold. The frostbite in the stock market also nipped hard at the bond market, which normally rejoices at any evidence that economic growth is frozen this close to the ground. This time, though, the bond ghouls were less interested in the kind of news that ordinarily elates them, the wintry sight of millions of other Americans miserably failing to get ahead, than with the increasing suspicion that the federal balanced budget plan they had taken for granted might in reality merely become the latest victim of that national capital of snow jobs, Washington, D.C. Balancing the budget would please the bond market, not just for its presumed calming effect on future inflation, but also because it would eventually reduce the $3 trillion supply of government securities currently on the market. By week's end, the yield on the benchmark 30-year Treasury bond, which dipped below 6% in late 1995 and early 1996, had crept back up to 6.14%, amid widespread pessimism that the rebound in rates would continue. There was, of course, a blizzard of activity in Washington, too, but regrettably it consisted only of blinding oratory. And speaking of slush, even the brutal storms that led the nation's news couldn't keep the oil rally going. Reports of rising inventories of heating oil, plus forecasts that temperatures in the battered east are going to turn warmer than normal next week, helped melt the crude oil market, which yesterday took its biggest one-day drop in nearly 2 years, and which ended the week with a loss of 10%. Amid all this unhappiness, gold, traditional beneficiary of chaos, managed to close above $400 an ounce for the first time in 2.5 years, but then backed off, like practically everything else in this week's winter wonderland, to end with a weekly gain of only 40 cents. Is there any refuge in this storm of a century? And who is right about this economy? The administration that keeps telling us we're in the best of all possible worlds, or the suddenly fearful financial markets, which spent much of the week looking for a place to hibernate? Tonight, in a special program devoted to the realities of the election year economy, we'll hear from powerful thinkers representing both sides of the aisle. But first, let's put on our long johns and mittens and see who was shoveling it in Wall Street in the week just past. And as the Dow Jones Industrial Average indicates, 1996 is rapidly beginning to resemble an unhappy new year for investors. As the snow piled up outside, the blue chips turned bluer, and the Dow ended at 5061.12. The 120-point loss was the biggest since June of 1994, and there were similar pile-ups in all the broader market indexes as well. Our elves remain tranquil, assuming they're not just frozen solid. Their +5 buy signal on the next 6 months hasn't changed in 11 weeks. About the only good news I can offer tonight is that if you're fed up with the weather at home, from Arctic in New York to blistering in Los Angeles, and feel like escaping abroad, the dollar this week gained buying power against every other major currency except the yen. So skip the sushi, but grab those other bargains. And meanwhile, we'll see if we can't improve the climate at home. We're going to begin our economic discussion tonight by talking with Joseph E. Stiglitz, who is President Clinton's chief economic advisor. Dr. Stiglitz was named chairman of the President's Council of Economic Advisors last June after serving as a member of the council for the previous 2 years. Dr. Stiglitz is on leave from Stanford University, where he has taught since 1988. Because of the inclement weather conditions in the Northeast, he joins us tonight from Washington. Joe, you have understandably described the economy in glowing terms, but in fact its slow growth rate continues to be a disappointment in terms of raising American living standards, doesn't it?
Well, I think you have to look at the perspective of where the economy's been and where it's going. We began in January '93 with an economy that was growing very slowly, that there was a lot of unemployment. Over the next 2 years, the economy went through a phase of recovery and grew very rapidly. We created 8 million jobs. We're now in a second phase where the economy's resources are basically fully employed. And once you get your resources fully employed, you can't grow as fast as you can in the phase of recovery. Obviously, we would like productivity to increase even faster, and we're trying to put together an economic agenda that does that. But in terms of where the economy is at this phase of you might call it the economic recovery, it's doing quite well.
A key part of the dispute between the Democratic president and the Republican Congress is over tax reductions. How far is the White House willing to go in reducing taxes to increase growth?
Well, there are two aspects of this. First, I don't want to forecast where the negotiations are going to go. It's difficult enough to make an economic forecast. The administration, however, has said very explicitly that as part of a budget deal, it's willing to have a moderate tax cut. But going beyond that would put in jeopardy certain key programs, Medicare, Medicaid, and would not necessarily promote economic growth. For instance, if you cut back vital investments in education, vital investments in research and technology, you would actually impair economic growth. So the linkage between tax cuts and growth is one that I know a lot of people like to make, but the evidence on that is not that strong.
Joe, are you afraid that we might have a recession this year?
No, I'm not. I know there's a lot of concern that if there's not a budget deal that will have adverse effects on the economy. But if you look at the underlying fundamentals of the economy, they are actually quite strong. We've been looking at that quite closely over the last few months and looking at what are the factors that in the past have contributed to economic slowdowns. And there are two factors that in the past have led to economic slowdowns. One of them is high inflation that leads the Fed to increase interest rates and then topple the economy. And secondly, big inventory buildups. Well, with respect to the first, we've had one of the best records in terms of inflation at this level of full employment that the economy's had in 30 years. And there really is no inflationary pressures. In fact, the latest reports have inflation basically completely contained.
So if the economy is as good as this, why does poll after poll say that the American people feel miserable, that they are not happy with this economy?
Well, I think part of this has to do with the fact that the economy has been going through a period of restructuring. In the process of restructuring, there's a reduction in economic security because as the economy gets more efficient, jobs are shed. Now, the great thing about our economy is that as those jobs are being shed, new jobs are being created, and that helps the economy become more competitive. A second factor that's important is particularly for those at the bottom of the income distribution, they have not fared as well. We have to face that fact. Real incomes at the bottom quintile of the population have actually been going down over the last 20 years. So that is a cause of concern.
To what extent does the White House pay attention to what extent are you personally concerned about what goes on in the financial markets?
We pay a great deal of attention to that, partly because long-term interest rates, one of the factors that go into going on in the financial markets, affect investment, and investment is really the engine to economic growth. We've had very strong investment over the last 2.5 years, 3 years. Investment's been growing at 15%. We'd like to continue that kind of investment growth, and so that kind of confidence in the economy that leads to strong financial markets there's a connection here between Wall Street and Main Street that we think is very important.
Is there any irony in the fact that the group of Americans who have done best under Bill Clinton are those in Wall Street?
Well, there is a certain irony in that, and I wish they would appreciate it more than they sometimes seem to appreciate it.
Joe, let me now bring in two other keen and possibly dissenting economic minds. Pete DuPont is one of the nation's most articulate exponents of smaller government and lower taxes, a former two-term governor of Delaware, an unsuccessful candidate for the Republican presidential nomination in 1988. Mr. DuPont is the policy chairman of the National Center for Policy Analysis. Alan Meltzer is an old friend of this program, tonight making his 5th appearance as my guest, a longtime advisor to presidents and would-be presidents, and a leading authority on the monetary policies of the Federal Reserve. He helped found the Shadow Open Market Committee in 1973. Professor Meltzer has been on the faculty of Pittsburgh's Carnegie Mellon University since 1957. Our 4th invited guest, Charles Schulz, who was President Carter's chief economic advisor, is snowbound tonight and regrets his inability to be with us. Pete, is the economy as good as Joe Stiglitz suggests?
Well, I don't think so. I think the interesting thing that Mr. Stiglitz said was that the lowest quintile of people in America have had declining real incomes for 20 years, and in fact, the quintile above that has had no economic growth in their incomes for 20 years. So 40% of the population has had a static pie. In that same 20 years, the take-home pay of the federal government, inflation adjusted, has risen 58%. Now there's fairness for you. The government gets a 58% raise, and the people who work in the country don't get any. I think, to borrow a phrase from President John F. Kennedy, we need to get this country moving again. We need a tax cut to get that done. And I heard Mr. Stiglitz say that the president would accept a tax cut, but I don't see any commitment to one. I don't see any real interest in reducing capital gains, which would be the quickest thing we could do to stimulate the economy.
Why don't you tell us exactly what you do on taxes, and then let's let Joe Stiglitz comment on that.
Well, I think first, a substantial capital gains tax reduction. Second, a repeal of the Social Security earnings tax, which is a grossly unfair tax on older Americans. Lifting the Social Security earnings limit so that we could bring back into the economy a great many older Americans. And then moving to some sort of a single rate tax that gets rid of this really retarding graduated income tax that is killing risk-taking and killing innovation in the country.
Before I ask Joe to comment, I think we should clarify a couple of things that might confuse some people who don't know your views as well as I do. When you say ending the Social Security tax, you're proposing a great deal of increase in voluntary savings for retirement.
No, and I'm glad you caught. I was referring to the Clinton tax increase on Social Security earnings, the 85% tax on Social Security benefits. On Social Security itself, we ought to make the individual part of that tax payment tax deductible, and we ought to move towards a market system. But to get the economy going, repealing the penalty tax that the Congress enacted in 1993 on earnings of older Americans would help.
And finally, how does your single rate tax cut differ from what's been called a flat tax?
Well, a flat tax presumably has no deductions. I think the important thing is that somebody who has 5 times the income of someone else pay about 5 times the taxes, not 3 times because he's taking advantage of loopholes, not 10 times because somebody in the Congress thinks he has too much money.
Joe, why doesn't Bill Clinton adopt Pete DuPont's tax policy?
Well, let me comment on a couple of the provisions that he's talked about. First, in terms of capital gains, the administration in 1993 did have a capital gains tax cut. It was targeted at new small businesses. Capital gains tax cuts that are retroactive, has been proposed, capital gains taxes that are not targeted, don't have any economic benefit. Now, do I have personally some reservations about some of these capital gains tax proposals? There are two reasons. One, if they're retroactive, they have absolutely no economic incentive effects. Secondly, the benefits go to the upper income individuals. It's very, very skewed in terms of the distribution of benefits. As Pete pointed out, we are in a situation where in the last 20 years the economy has benefited the wealthy individuals the most and the poorest individuals the least. This is hardly the time to have a tax cut, the benefits of which go all to the upper income individuals.
The administration acknowledged this past fall that its own 1993 rate increases had not brought in the revenues that were anticipated. Is there a pattern here? That when you raise rates, you don't get the additional revenue you expect?
No, actually, I'm not quite sure what you're referring to. The fact is that one of the things that did happen was that some individuals, in anticipation of the tax increase, shifted income from 1993 to 1992. But in terms of overall increases in tax revenues, things have been going just right on target, reflecting, in fact, the increase in the GDP of the economy.
Alan Meltzer, do you agree that a capital gains tax has to be targeted to specific parts of the economy in order to be helpful?
Well, I think it's the way in which this administration approaches the problem, and that's typical. I mean, they want to micromanage the problem. They want to try to figure out who should do what, rather than give general broad goals for the economy and let the private market take over. And I think that's their problem, and they're stuck with it.
I introduced you by saying that you were a preeminent authority on monetary policy, so tell us what you think of Alan Greenspan's monetary policy.
Well, I think Alan Greenspan is the best chairman the Fed has had, and I'm writing a history of the Fed now so that I've looked into what the others are doing. But right now he's running a policy that I have believed for several months is too tight. I think when I was here last year I told you that we should cut interest rates, and they've been very slow to do that. I think there's some more cuts that have to come if we're going to keep the economy growing.
You told us a year ago that they shouldn't raise rates again. They went ahead and did it. We have had quite a slowdown. Why is he such a great chairman of the Fed?
Well, he's better. I didn't say he was great. I said he was better than all of the others, and that's damning him or perhaps praising him with lightly. But he is better than all of the others because he's managed to do what Joe described a little while ago, to bring us to this 5-year growth period with very low inflation, so that instead of facing the prospect that we would have to slam down on the economy in order to slow inflation, we have the opportunity to cut rates this year, and we ought to get going doing that.
Pete, are you happy with monetary policy?
I think so. I think Mr. Greenspan's done a good job, but I'd like to come back to what Joe said about a capital gains tax generally not helping the economy. Economies prosper that have the easiest way, the highest liquidity in capital movements within the economy. Unlocking the capital gains in the American economy would give a huge boost to the economy. And I just think the administration, particularly Vice President Gore, who the other day, according to press reports, was arguing vociferously inside the White House, meeting with Mr. Gingrich and Senator Dole, that the capital gains tax cut could not be considered because just for the reasons that Mr. Stiglitz said, but I think they're both in error there.
Joe, I'll give you a chance to reply.
Yeah. Well, first of all, the evidence that of the significance of the locked-in effect, to which Pete referred, is just not there. There is no evidence that that would be a way of having significant effect in stimulating investment. Secondly, there's actually a link here between overall monetary policy and tax policy. What you want to do is free up resources in the economy to allow investment to occur. The way of doing that is obviously cutting back on federal expenditures, the size of the federal government. Now, we've done that. We've now reduced the number of federal employees down to the level that they were in 1963. As a percentage of the civilian labor force, we'll be down to the level we were in 1930s, and yet the government's providing enormously more services. So that part we're in the process, or we have already done. Now, as you cut back on government expenditures, that leaves more resources to be spent on investment, and the Fed is responding by lowering the interest rates. That's an across-the-board, even keel way, not giving special breaks to some people and other breaks to others. It's really a neutral way of doing it.
Joe, in a nutshell, how important to you is it that we reach a balanced budget agreement?
I think that what is important is that there's a bipartisan resolve to reach a balanced budget. Both sides, the president actually has proposed a balanced budget that will reach a balance by the year 2002. And I really hope that an agreement will be reached.
Pete, do you think it's critical?
Balancing the budget is less important than growing the economy. This economy rises or falls on growth, and we ought to refocus our attention from counting the beans to making the bean plants grow higher.
But it was your own Republican Party that brought this front and center as the issue for this year.
And I think that has cost them a lot in blood and treasure. I think they'd be better off with the Reagan growth philosophy than with the bean counters.
Alan, what's your perspective on that?
Well, I think it's useful to move toward balance in the budget, but the most important thing is to cut government spending as a share of output and to cut tax rates and let the private sector expand relative to the government. That's really where we need to go.
What is your economic forecast for this year?
I think that the economy will be very slow in the first half of the year, and people who disagree with that are mainly counting on the Fed cutting rates. That is, I think the Fed will cut rates too, but if they don't, then it's going to be weak and it could go into recession. But and I think the inflation rate will be very low, probably below 2% for the first time in many years.
You also look at the money supply figures. How are they doing?
They're doing pretty abysmally. They've been growing very slowly. But if you look, whether you look at rates, the market, you talked about that in your opening, the market already has built in a rate cut. The money supply growth is abysmally low at the moment.
Pete, if you had been elected president, if you were elected president this year when you're not running, what are the first things you'd do about the economy?
As I said, I'd like to get, I think we could double the growth. I'd like to move to a different kind of a tax system instead of this corrosive, loophole-ridden thing that's holding our growth down. Secondly, I'd like to undertake a massive program of deregulation in telecommunications, in education, so that people can begin to innovate and use their energies and their skills and get the focus of the economy back on the individual instead of with Mr. Stiglitz in Washington.
Well, Joe, let's give you the last word, give you a chance to react. Is any of that making sense to you as a representative of the Clinton administration?
No. Well, much of it does, but some of it doesn't. Some of the policies that Pete has been talking about are the failed policies of the Reagan administration that got us into the problem of the huge deficits that we are. They cut the taxes in 1981, and that's what started the huge deficit problem that we have today. The Clinton administration does believe in strong growth and has a positive growth agenda that is based on deficit reduction, on investments in education, investments in people, investments in infrastructure, investments in R&D and technology. It has a export-oriented export-oriented policy that's 25% growth in exports in the last 3 years, and it has a policy that is consistent with what Pete talks about, reinventing government, trying to make government more efficient, focusing it on the things the government ought to do. But whereas for 12 years the Bush and Reagan administration talked about doing something, we've actually been able to actually do something in this area, and with I think, very positive results. Thanks very much, Joe Stiglitz, Pete DuPont, Alan Meltzer, for giving us a wonderful report on two entirely different economies. I hope you'll be back with us again next week. Our guest then will be the chairman of the New York Stock Exchange. He's Richard Grasso, and we'll be asking him what the big board is doing to meet the challenges from its ever more aggressive competitors and from the changing technology of the 21st century, and whether it all will result in a fair exchange for individual investors. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser is a production of Maryland Public Television, made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you. By Prudential Securities, with more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. By A.G. Edwards, going beyond stocks and bonds to help you create the right plan for a more secure retirement. A.G. Edwards, serving investors for more than 100 years. And by Oppenheimer Funds, because solid investment performance and sound financial planning go hand in hand. Call 1-800-685-4654 to order the complete year-end recommendations of the 22 panelists, plus the transcript of Lou's year-end program for $5. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.
Wall Street Week is brought to you locally by Piper Jaffray and its employees, proud sponsors of Wall Street Week for the past 20 years. The law firm of Oppenheimer, Wolf & Donnelly, serving the business and legal needs of its clients worldwide. Winthrop Resources and Winter Business Credit, providing equipment lease financing to companies nationwide. And by Deluxe Corporation, providing check printing and related services to America's financial industry.
Tonight, find out what the birds are really saying to each other on Newton's Apple. Get down and dirty with amphibians on Eyewitness, and go deep-sea fishing with nature in The Hunters of the Sea Wind. All this and much more tonight on Channel 2.
Monday, tapes rolling on Minnesota women on ice.
We give as many people the opportunity to play as they want to play.
You just try to react to it and do your best.
You can play hockey at any age. A wonderful, exciting sport.
Tapes rolling, Monday night at 7:30, here on Channel 2.
The 3,000-mile garden brings Roger Phillips into the halls of power.
I feel driven to start a campaign.
And some homemade bread from a homemade oven.
The country bread, which is Bill's favorite, came out especially well.
Pollen, politics, and personalities.
Think tiny. Think tiny pie.
Served up next time in the 3,000-mile garden.
Thursday night at 7:30, here on Channel 2.
On the next Newton's Apple, we're listening to what the birds are saying.
It's just wonderful and beautiful.
Just trying to get comfortable.
See, this is a cinch.
Exploring the latest inventions.
This is the gutter getter, and it gets balls out of the gutter.
And playing with these creepy crawlers.
It's gross.
We're teaming up for adventures in science on the next Newton's Apple.
Tonight at 7, here on Channel 2.
Born in water like fish, they grow legs and walk on land. Amphibians have fascinated us throughout history. The ancient Egyptians believed frogs were divine and that men and women were made by the frog-headed goddess Hecate. Do we celebrate frogs and toads for their human qualities or because they provide clues to the story of evolution? Leap into an ever-changing world as Eyewitness takes you where nature, legend, and myth combine on Amphibian.
Tonight at 7:30, here on Channel 2.
Major funding for cooking and culinary arts programming on KTCA is provided by Cooks of Crocus Hill, the kitchen on Grand Avenue with hundreds of cooking classes, classic equipment, and exceptional food gifts. Additional support is provided by Twin Cities Natural Foods Co-ops, making healthy choices easy at 7 convenient locations.
Bert Wolf's Menu is made possible by Crate and Barrel. Crate and Barrel, specialty housewares and home furnishings since 1962.